Hi, everybody. Really appreciate you guys joining us tonight. I'm Nick Elder with Ironton Capital. I've got Lon Welsh with Ironton Capital and Sean Ross with 1031X. How you guys? We're going to walk through, again, a lot of great information here. Sean's going to detail some information about what the 1031 process looks like for those who want to go that direction. If you're selling a rental property, a couple rental properties, whatever your situation may be. If you don't want to go the 1031 option, we will also be introducing an alternative method that we utilize with a lot of our investors here at Ironton Capital. So a lot of great information here. We're going to be going through some analyses and some case studies. So again, if you guys have any questions, throw them in the chat. Before we get started, a quick note from our attorney here. Obviously, this is an educational presentation, but you may see some comments in here such as projections or some projections such in words such as expect, plan, seek, intend, anticipate, etc. Please understand any projections you see are just that. They are projections, they're forward-looking statements based on, some of our own internal analysis, regarding our funds, and of course the analysis presented here in the presentation. Any investment in a fund involves high risk. This is not an offering of an investment opportunity. So please keep all those things in mind. Now that we're through the very exciting legal jargon slide there. Quick overview, a little bit, whether you're familiar with Ironton Capital or you're brand new and this is one of your first presentations with us, Ironton Capital, we're a private equity firm specializing in real estate. We also have a medium-term income fund that specializes in non-correlated asset class such as medical receivables. So whether your goal is growth or cash flow, we have several fund opportunities that give you those solutions and match your investment strategy. So here's a breakdown here. This slide deck will be going out as we get to the end of the presentation, or once you digest a lot of the information. If you have any questions about our current offerings and you want to discuss potentially being a passive investor, please feel free to reach out to us. The last slide will have a contact link that you can go to book a time with us. That being said, Lon, I will turn it over to you to kick it off.
That sounds fantastic. So I want to talk a little bit about an actual client case study of someone who had a rental property and they were getting kind of annoyed with it. And one of the options was to sell it and do a 1031 exchange. And Sean's going to talk a lot about the different options and permutations of that. And then the client wanted to know, well, maybe I'm done being an active landlord. What other options might I have? So we're going to walk through all the different options and what the financial analysis was for all of those. And we wrote a book with Sean and I on 1031 exchanges and how they were impacted by the most recent tax law changes. So if this is of use to you, feel free to reach out to Nick, and he's happy to send you a copy of the book for free so you can learn all about the research that we did on that. So this rental property was bought for $184,000 about 6 years ago. They put in a little bit of money for renovation, just about doubled in value. And the last renter they had, you can see the details here for their cash flow. So they're generating a monthly cash flow after their loan expense of about $700 a month, or about $8,400 a year. So the first question we had was, well, what kind of appreciation can we get in addition to that cash flow? And this client thought that somewhere between 3% and 2% would probably be appropriate. We put in 2.5%. So if there was a $300,000 value of the unit, 2.5%, that's about $7,800 of appreciation. Add that to the cash flow that it generates. The total return of this property is about $16,000 a year. And then what we did is we just divided that $16,000 of total return into the equity of the property, about $185,000, and they're getting about a 9% return on their money. And Nick and I have probably done close to 100 of these analyses now, and this is a very common situation that a lot of investors have had so much appreciation so rapidly. It's like the gift from heaven, that the return on equity isn't all that high because the cash flow that generates is being spread over a huge equity base, and it ends up not being that huge of a return. So that's the baseline. So the first option is, let's just do nothing. Like, this has been a cash flow machine for me for 5 years. What would be the wealth accumulation for my family over the next decade if all I did is hold on to this asset? So we took the equity in place right now. There's no transaction costs. There's no capital gains taxes. We're not selling it. And if we just get 9% per year compounding, you can see that over the 10-year period, you end up with $430,000. So even at a relatively low rate of return of 9%, your equity will more than double over 10 years. So there's nothing wrong with holding on to a rental if you're not annoyed by it, because that'll be a great option for you. So I'll pause there and see if you guys have any questions about that.
No questions yet.
Okay. So the next option we wanted to look at is, well, what if we sold it and we did not do a 1031 exchange? What would happen then? Well, we estimated that the cost to sell the property would be around $19,000. So commissions, title fees, giving some concessions to the buyer on the inspection. So with the equity that we've got in the property, $184,000 minus those sales costs, we walk away about $165,000 before any tax bill. So the first thing we wanted to take a look at is, what if we put it in the stock and bond portfolio? So if you take a look over the last 50 to 60 years with a typical stock and bond portfolio, a typical return is about 8.1%. So that's what we looked at. We did a quick back of envelope estimate. You can see we thought the capital gains would be just a little under $30,000. So the amount we could redeploy would be the old equity of $184,000 minus the transaction costs, minus the capital gains. We have $135,000 to invest. We're going to get a blended stock and bond portfolio of 8.1%, and that's going to grow to be about $295,000 over the next decade. So you'll remember, if we did nothing, it would grow to $430,000. So you make less money by selling it and paying the taxes and putting it in the stock market. The advantage is it's completely passive. If you want access to the money, you can sell it and have it 3 days later from Fidelity or Vanguard. And you've got a lot of optionality in how you choose to invest it. Or if you want to take some of it out and pay for your kids' college education, do that. So that was the first alternative that we wanted to examine. The next is, what if we put it into our MTI, medium term income fund? So the equity we can invest would be exactly the same. We have the same transaction costs, the same capital gains. The rate of return for MTI is between 11 and 13%. The more you invest, the more you get paid. I picked 12 as the midpoint. What you find is that this property's equity would grow to about $420,000 over a 10-year period. So a little bit less than if you were to just keep the rental property, but it's pretty close, and it's completely passive, and you've got decent liquidity. So some pros and cons to that. The next thing we looked at was the DST. And Sean, do you want to talk a little bit about what DSTs are, and do you see those often with your clients?
Yeah, it's a good question. DSTs are really popular nowadays. They've been getting more and more popular over the last 10 years, but especially the last 5 years. I'd say since COVID, DSTs have really taken off as more and more institutional players have been setting them up and running with them, and more investors have been switching from active management to passive management. The idea is this: you want to think about it in terms of investing in a company, right? You can buy shares of an individual company, or you can buy a mutual fund. Both of those, you're buying ownership in something, but you're not managing it. You're just hoping the person that manages it gives you a return, a dividend, or pays out something on that money. DSTs are set up sort of similarly, which you can buy into a building along with a pool of other investors, or a set of buildings along with a pool of other investors, and some other entity, a sponsor, is going to be managing that asset. It's going to take your investment, it's going to buy the property with other investors, and then at some point in the next usually 3 to 7 years, they're going to sell that investment again. And then over that 3 to 7 year period, you'll often be getting a payment monthly or quarterly from the rents that it generates. And then when it's done, you'll get ideally an appreciated investment return back. And then you have the option at that point to either do a 1031 exchange or go somewhere else. DSTs are, think of it like a bond replacement almost, right? They tend to be higher quality institutional real estate, Amazon warehouses, storage facilities, medical buildings, student housing complexes, that sort of thing. Very common for DST structures. They tend to take down properties that are in the $15 to $150 million range in that space. And the idea is to get access to a higher quality or different type of property than most investors go out and buy on their own. And it's set up under a special rule under Delaware state law. That's why I call it a Delaware statutory trust, where your fractional ownership in the property still counts as deeded ownership to you, even though you're not on the loan and you're not managing the property. They're not a panacea. There are pluses and minuses to DSTs, but they're popular because you can set up quickly, you can identify them quickly, and they are passively managed.
Excellent. So historically, the rate of return from the research we did for DSTs is in the 8 to 10% per year range. So I picked the higher end of the range at 10% a year. And one of the great things about this is that there's no capital gains tax because Sean will help you with the 1031 exchange. He'll talk more about that in a minute with all the mechanics of that. So the returns on this would be around $475,000. So you could actually sell your problem rental, do a 1031 into a Delaware statutory trust, and actually probably make a little bit more money without the headaches. So for many of you, that might be an option you'll want to really think about. And it's no surprise that Sean's found that those are pretty exciting to a lot of investors. So another option is you could sell the thing and do a 1031 exchange into a new property. So we should probably just pause for a second. Do you want to do like 1031 101?
Yeah, let's skim through this quickly. So for those of you who don't know me, I should have introduced myself earlier. I run a 1031 exchange intermediary that's based in Denver, but we work nationwide. And our job is to help investors sell appreciated property and then reinvest into other investment property. And if you follow a certain legal procedure along the way, the IRS says you don't owe taxes on your sale. Your taxes get deferred. Your basis in the property carries over into the new property you're reinvesting into. So a classic scenario is somebody has a rental. Let's take a common story we've heard a lot. Somebody's in Colorado and they have a rental property that has appreciated a lot, and the landlord laws have changed and it's harder to run your property the way you want to there. So they say, done with this, I want to take my money and go somewhere else. They can hire us to come in there. And what we do is legally, what happens is we step in and sell the property on their behalf. It doesn't feel that way practically, but legally that's what happens. The money from the sale goes into a specialized escrow account, and it sits in that escrow account until they find a new property to reinvest into. So let's say they go into a spot in the country where the average home price is smaller and your return on equity tends to be higher. So they're in Kansas City, or they're somewhere in the Carolinas, or in Georgia, Oklahoma, very, very common, Northwest Arkansas, blowing up in popularity lately, right? So you go buy some property down there where your dollar stretches further and you get better cash on cash return. If you reinvest through, I'm not going to go through all the rules, but if you reinvest into another business or investment property within 180 days of your sale, and the property that you reinvest into is worth at least as much as what you sold, you can defer your taxes on that sale. And the math here that Lon has placed out walks through what something like that might look like. The punchline there is 1031 exchanges have to be set up prior to your sale, and you need to work with a company like ours to do it. You cannot do it on your own. We're a creature of the tax code. So you have to work with a specialist who's set up to facilitate the exchange. And then at the end, you just own a new piece of property with a lower basis than you would have if you had bought it outright. And at that point, you can manage that property. And if you sell that down the road, you either face the taxes that you would have owed upon sale the first time, or you can do another 1031 exchange into another asset after that. I can pause to see if I went through anything too quickly, if you guys want me to cover any other ground, but that's the basics. It's you sell, defer taxes, reinvest, and then for many people, rinse and repeat.
So I think to reiterate, there's two deadlines, right, when people need to be aware of. So there's the 180-day deadline by which they need to close. There's also a 45-day deadline, right? So there's from sale of their original property. They need to identify 3 properties that they would like to acquire within 45 days. And then they must acquire one of those 3 in the 180 days. Is that right?
Yeah, without getting too far into the weeds, because there's a lot of nuance here.
Sure.
Let's imagine that you're closing on a property tomorrow, April 15th. That's day 0. By day 45 thereafter, you have to identify up to 3 properties you're thinking about buying next. So property A, property B, property C. And you can change what's on that list during the 45 days after your sale. But on day 46, you're locked into your final version of that list, and you must buy a property or properties from that list in order for your exchange to be valid. Gotcha. And then you have 135 days after that for a total of 180 to close on something that you've identified properly. So the 45-day deadline that you highlighted, Nick, is often the most restrictive and challenging part of any 1031 exchange. For any standard 1031, That's the real small, narrow box the IRS puts you in that you have to comply with. And for most people, that's where you really start to sweat, because a month and a half goes by very quickly for a lot of people when they're looking for property.
Yeah.
And
So
Lon can speak to this because
maybe
he's done
two
dozens
properties.
and dozens of exchanges.
Yeah, so if you've got 2 properties and you want to have a backup plan, would you have 2 properties and maybe a DST, and that would be the 3?
Yeah, in fact, what we've seen lately is you say, okay, I know that I want to buy a duplex or a quadplex, or I want to buy, maybe I'm trading out of a Jiffy Lube and I want to go to some other triple net commercial property. You identify 1 or 2 of those, and then as your deadline starts to creep up, maybe your third slot, you slot in a DST or some mineral rights, some oil and gas rights, which can be 1031 eligible depending on how it's structured, or maybe some private placement if it's structured to accept 1031 capital. You often do want to have some break glass in case of emergency options, so that if you're, let's say, the first property you find you like, but you can't negotiate with the seller, or it fails an inspection, or for some other reason it falls through, then you want to have something else that you can fall back on and close on quickly. And DSTs happen to be very good for that.
Excellent. Always have to have a couple fail-safe plans.
That's right.
So the replacement property, if you decide to be another active management property, the rate of return could be all over the map. It's impossible to know. I assumed that you got something about 5.5% higher, and that you got something at a 14% investment rate. So with that, this becomes a really fantastic option. Your equity would grow to $715,000. If you got something closer to 10%, it'd be more in the 400s. So that rate of return investment assumption is really, really critical to the outcome that you get from it. So if you're in the process of selling one of your anchor properties and you've got a couple of different exchange options you've identified, feel free to call me up, and I'm happy to do the math for you to figure out how those pencil out. And you'll probably also want to call up Sean. Sean, you have to be hired before the sale, right, for this to work?
Yeah, from a legal standpoint, the 1031 has to be put into place before closing takes place. From a practical standpoint, and I can't stress this enough, you want to have conversations with a company like ours and your accountant or your broker, or your financial advisor well in advance. But by the time you're listing the property, ideally, not always necessary, but often very important, because 1031s are an incredible tool, but they don't solve everything. There are circumstances where they're not the most appropriate thing for you to do. And it really helps to have a longer term vision for where you're going. Because remember, with a 1031, you're just deferring taxes. You are not eliminating taxes the way you do if you sell a primary residence and claim your exemption under Section 121. And if you don't have it mapped out long term, you can find yourself holding a very large tax liability down the road, that you end up wishing that you had faced some of the tax burden earlier. Not always, because compounding your equity over time is a really good idea, but you want to have conversations early to map out the rules and the options.
Absolutely. That's fantastic. So if you guys have any questions, feel free to drop them into the chat box, and we'll try to address all this for you as we go through this. So a final example is, I assume, what if we were to put the money into our long-term investment fund, the National Diversified Fund? So we have 2 different types of share classes. The A share class gets a slightly higher preferred return, but it gets no depreciation. And the B share class takes all of the depreciation right off, and it gets just a little bit less on the preferred return. Usually what we find with clients selling a rental property they've actively managed, they consult their CPA and they find that the depreciation we can give them can be used to offset dollar per dollar the capital gain that they're going to incur from selling that active rental. I'm sure there's going to be some situation where that's not true. I'm not a CPA, so for sure talk to your financial advisory team. But generally speaking, that's what we see will happen. So what you'll notice here is that when we have got the old rental that we sell, it's the same $184,000 of equity, same transaction costs, but instead of it being $30,000 of capital gains, it's only $15,000, because we can shield a part of your capital gains. Depending on the situation that you're in, we might be able to reduce your capital gains liability quite a bit. And other times it'll just be like a chunk of it, and then you'll still have a fair amount left over. So by no means is it as good as a 1031 exchange, but it's certainly better than nothing. And we can run the sensitivity analysis for you very easily. So our target for the National Diversified Funds is somewhere between a 16 and 20% annualized return. I put in here 17, and you can see over a period of 10 years that grows to about $720,000 of equity. And you've saved a little bit on your capital gains. You'll have to pay that later, just like you would if you did a 1031 exchange and then you sold that replacement property down the road. That would also have a tax liability. So it's the exact same tax structure. So let's take a look at all the options just on one page. If we just hold on to the rental and do nothing, our equity will grow to about $430,000 over the next decade. If we sell, pay the taxes, do the stock market, about $290,000. If we sell, pay the taxes, and do the income fund, so I get a quarterly distribution, about $410,000. So a little less than do nothing, but pretty close. If I sell and invest in the Delaware Statutory Trust, the result's going to depend on the returns and appreciation of the DST. 8 to 10% is typical. I picked 10%. If that's the case, you'd come up with about $477,000. So it's a slightly better option in that scenario than do nothing. You could sell it, do a 1031 exchange, get a new rental, and again, it's going to vary wildly depending on the rate of return of the new rental. I picked a relatively high number, and in that case, you do quite a lot better than do nothing. You could sell. Nope, the DST's in here twice. I apologize. Or you could sell and invest with us in the long-term fund, take advantage of the depreciation to shield some of your taxes, and you'd wind up perhaps, depends on the results of the fund, around $690,000. So there's quite a lot of range of options here, but the great news is that your $180,000 or so of equity is going to do a lot over the next 10 years, regardless of which of these wonderful choices that you pick. And I probably should just give this back to Sean. I'm sure you've got like a bunch of observations about this as well.
I got a couple of comments to add and then a question there too. So for people, just to reiterate, if you're looking at the DST option, that's also a 1031 exchange option, right? So you 1031 exchange into a DST, or if you 1031 exchange into an actively managed property, that's that $713,000 line. As Lon mentioned, the actual return there varies dramatically. And as a case in point, if you were somebody that did a 1031 exchange and into new actively managed property over and over and over again in the state of Colorado over the past 25 years, you would have done extremely well for yourself on average. If you were doing that exact same maneuver in the state of Ohio over that same time period, you would have had dramatically lower returns on average. I mean, it's possible that some of your investments would have really panned out, but this is a scenario where location really matters, management really matters, your tenants really matter, local laws and regulations really matter. So the spread on 1031 exchanges, and there's going to be a spread no matter what you do, just based on market conditions. But that option should be evaluated based on your ability and confidence and desire to go find that that either that diamond in the rough or diversify your portfolio in some degree. Again, I can't stress enough how important it is to involve your financial advisor, your tax advisor, and talk to a 1031 intermediary, because I don't want you to get the impression that if you just plug and play with a 1031 exchange, you're guaranteed to get the largest bar on this graph right here. That's not the way it works. Some people are going to do a lot better than that, and some people will do worse than that based on conditions and timing and location. So that's the first point I wanted to make. The second is 1031 exchanges, and this might be true also of the long-term fund law, and you'll have to jump in here and help fill in the gaps, but because you're not eliminating the tax burden and the tax liability, the real, if you want to call it miracle or the real magic of doing the exchanges, your equity gets to keep compounding on its full amount over time, right? The reason this works is because instead of the IRS taking a big chunk out of what you've appreciated and earned and paid off, paid down your mortgage over time, that equity grows and grows and grows uninterrupted. It's like a snowball rolling downhill. And if it doesn't hit anything along the way, then it gets pretty big pretty quickly with the right conditions. That's the whole concept and idea, but you want to know what's at the bottom of the hill. When the snowball's rolling and rolling, you're getting all this equity, all this appreciation. What happens when it lands at the bottom? You want to have that figured out earlier and then keep updating that plan as time goes on. Otherwise, you get stuck with a really large tax liability. I'll say this too. What a lot of people, sort of multi-generational wealth building families do is they'll exchange multiple times over, out of one asset into another, and they're diversifying and adding more doors or different types of investments. And then when they die, they pass along their portfolio to their heirs at a stepped up basis. and you might have estate tax complications in that spot, but that's one version of the bottom of the hill where you really do get to eliminate the tax liability, not for yourself, but for the next generation. That's something that we see pretty commonly among people that are serial 1031 exchangers. Or you might rely on the fact that you're just going to be in a lower tax bracket later on, or even if you're paying taxes, 20 years down the road, your equity has grown so much over that time that on net, you're still much better off for having done it. Just a few things to keep in mind. And the punchline here is not memorize all these rules and scenarios. It's just know that you need to talk with people that have been through this before and can help walk you through your circumstance specifically to see if it makes sense for you to go down that road or not. Otherwise, you're going to want to consider some other options. So those are my first. I'll pause there so you guys have questions based on what I said.
And there's a lot of content in the book where you talk about special things to think about, who should be on the advisory team, how do you hire those advisors? What are some of the maybe one or two big takeaways from that research that you did for the book?
Yeah, and some of this is anecdotal from my own personal experiences and what we've done at the company, and some of it is based off of talking to people that exist in those spaces that I know and trust. Just having a CPA or just having a financial advisor is in and of itself very often a good idea, independent of whether a specialty and knowledge is. But if you can find somebody that has real experience and exposure to real estate investments in particular, boy, does that put you ahead. Because what a lot of brokers and what a lot of accountants and a lot of attorneys will do is you'll bring up a topic like investing in a private equity fund like Ironton Capital or doing a 1031 exchange, and they will nod their head because they don't want to seem like they don't know what they're talking about, and then they'll go on to Chat GPT or Google and see if they can quickly catch up to what you just asked them. It's better if you find somebody who has been through it before and can give you real advice. The other thing I'll say is they have very specific roles to play, and you want to let them stay in their lane. You get into real trouble if somebody is going to be advising you on every element of that. In our industry, we're prohibited from acting as an advisor or an accountant or a lawyer or a broker. We can't be a 1031 provider and any of those services. So we sort of get blocked from that legislatively, but not everybody has those restrictions, and some people like to play in spaces they shouldn't. Just be cautious that you're working with somebody who stays in their lane, who has experience in what they're doing, and who you trust to listen to your entire what you actually need. When I was a financial advisor, I had a lot of people who were very successful in my company who were very successful because they just put everybody into the same products over and over and over again. Those products happened to pay them the highest commission. You want to do your research to see how are people getting paid and what are the incentives for how they get paid too while you're at it. So that's a grab bag, shotgun approach to answering your question there, Lon, but it is an important thing to think through.
Yep. I thought one of the most beneficial parts of the book that when we wrote it is who's on the team, what due diligence questions do I have to ask, regardless if I'm doing a DST or investing with someone like us or just buying another rental. If my family isn't as knowledgeable about real estate or as passionate about it, what things do I need to do to bring them along and make sure they're properly educated? If I do want to invest in a private equity fund like Ironton, what questions would I ask from a due diligence standpoint? How do I evaluate the answers? We tried to put a lot of tools in there to make it really easy. It's free. We don't charge you for the book. You can just
I do have one question, Lon, actually, quickly before we move on. And this, you had raised this early on, maybe several slides ago, but it was with the income fund. The meeting you mentioned your return will grow as the amount you invest grows. And I heard that as meaning your actual rate of return can increase based on how much you put in. Can you just explain that mechanic? I think I know what the answer is, but for anybody else who might have caught that and wondering why it works that way.
Oh, great question. And Nick can probably help me out with this too. So the assets under management that you have with us, and it doesn't matter if they're like in the short-term income fund, medium-term income fund, or one of our long-term funds, we add them all together to get a global assets under management that you have with us. And the higher the amount you've entrusted us with, the higher the percentage rate we can pay you on the medium-term income fund. Nick, did I miss anything on that?
No, that's spot on. So, I mean, there's a step tier, obviously. The middle point of that 12% a year is about $500,000 in assets under management. And then once you cross $1 million, you end up at 12.5 and then 13%. So just a little bit more detail there. That was it.
Fantastic.
We do have a question that rolled in here. I got a question for you too, Sean, but I'll let Tom go here first. So he says he's closing on 2 properties at the end of this month, and he has a 1031 intermediary. He's looked into Delaware statutory trusts, and he's finding looks like 5% annual returns or 5% distributions. He doesn't want anything with no income for 5 or 10 years. He's also looking at 1031 into oil and gas. Also looking at paying some capital gains and going into our medical receivables fund. What else should he be looking at or considering?
Okay, I'm going to make some assumptions here, Tom, so correct me if I'm wrong on any of this. But the first is you're looking for passive income, right? You're looking for some kind of, we call mailbox money sometimes, right? Because everything that you listed there is not an actively managed investment. Yep, okay, so very common, I would say, over the last 2 years especially, we've seen an enormous amount of people asking exactly this version of the question. What can I look at? How can I get the most for my dollars without me having to manage the property myself? In this case, the 3 you've mentioned, right? DSTs, oil and gas, and then looking at what are some other non-1031 passive options that I could consider with after-tax returns. Those are the top 3 that we usually recommend people look into. Beyond that, there's a whole host of they're not structured the same way a DST is, but passively managed investment options available to you through a 1031 exchange. A triple net lease might be the simplest version of this, right? You buy a property and then you have this usually will be a single tenant. Maybe it'll be like a Starbucks or a Dollar General or a CVS, something like that, right? Those are passive investment options that are 1031 eligible that you can look into. Or there might be a tenants in common structure out there where you can have up to 35 investors, although usually it's closer to 5 or 10, all going in to buy usually a commercial or multifamily asset together. And sometimes there'll be a master lease agreement in place where somebody else is doing all the management for you. That's an option you could look into. There's a new kind of alternative to DSTs that's fresh on the market. I think it's less than 2 years old at this point. It's called a direct title security. And that's a securitized portfolio of single family residences that you can invest into. And you actually own the actual single family house, but there's a tenant in all of them already, and that tenant sublets the property, and you get a return from the tenant, and they make whatever the difference is on their sublease. Those are all, there's a plethora of passive investment options that you can look at. Most of them are going to be a little bit more involved and a little bit more tedious than a DST on average in terms of management. If you're looking at non-1031 options, there I'm going to recommend a good financial advisor or talking to someone like Lon and Nick about their funds, because I'm not the guy to walk you through all of those. You're in a spot where it really depends on, are you looking for preservation of capital and security, or are you looking for maximizing my dollar on dollar return? And then do you care about geography? Do you care about sector? What parts of those things really matter to you? How long are you going to hold the next investment? What's going to happen after? Those are all questions that are going to help you fill out what that might look like. But you're not, in today's market, from what I've seen, you're going to have a hard time finding a passive option that's going to give you returns that can compete with actively managed real estate. It's just the trade-off you're going to be making.
Mm-hmm.
Yeah, what we found is that the 4 to 5% cash on cash return on the DST is pretty typical. And then over the life of the DST, you might see 2 to 5% a year annual appreciation. So that target case of the 10% a year return on the DST, that'd probably be half cash, half appreciation. So if your needs are more income today, then the DST may not be the right answer for you. So thank you for sharing all this. It's always good to get new market intel.
Let me say one more thing about DSTs quickly, which is DSTs, all real estate is considered illiquid as far as an investment goes, right? It's hard to go out and you can't just sell part of a house tomorrow, right? The same way you can with stocks or bonds or, gold or something. But DSTs are particularly illiquid. You are often locked into an undetermined amount of time in your investment window. So if you invest in a DST, you're stuck with that sponsor until they decide to sell the asset. And they're not going to tell you up front when that's going to be. They might have a target. The target might be 5 years out, but sometimes they hold it for shorter and sometimes for longer. So if you have future need for the equity that you're putting into the investment and you think it's going to be before that sort of 5-year mark, you really want to look twice at DST or maybe have another option alongside them, just in case you got to pull equity out, because the secondary market for DST investments is terrible. And you're going to take a big haircut. If you can exit at all, you're going to take a big haircut on what you pull out.
Sean, is there a minimum financial qualification or minimum investment to go into a DST offering?
Yeah, the answer here, it depends on whether you mean formally or not. So formally, yes, most DST sponsors will say 100,000 minimum, 250,000 minimum, $500,000 minimum. You'll see those thrown around. If you have a DST broker or the right relationship, the right 1031 company, they'll get you in there for a lot less. I've seen people, pack $10,000 into a DST. If somebody tells you, for example, it's $100,000 minimum, they're going to take 90,000. Most of the time, they'll take 75. Some of them might take 50. It just depends on who you're talking to get you in there. Some sponsors are strict on it, but most are not.
Gotcha. Another question: can they, meaning the DST, surprise you when they decide to sell?
They can. I mean, you want them to give you as much advance notice as possible, but yes, the answer is they certainly can. Now, it's not like you're going to wake up and next week you're closing and you had no idea, but there's DSTs back in the day when they first came out, they would tell you, like, this is the target sale date. And what happened was sometimes they would sell before or after, and it would piss off everybody who they told when they were going to sell. So now they don't even tell you. They just say it's going to be at some point. This is the window we're shooting for, and we'll let you know as soon as we have a deal in place. But so it depends on what you mean by surprise there, Benson. But you're not going to get a ton of advance notice because they don't want to upset anybody by getting it wrong.
I'm guessing the ultimate exit of this DST is when everything in the basket sells. Is that correct? I mean, maybe you have like 100 properties in there. They're all high quality. Let's call them bond, AAA rated type investments. There's an ultimate exit, right? But they're not all going to exit in the same year. Maybe some exit, ahead of time. And then do they recycle that capital forward, or how does that all?
Yeah.
Okay.
That's a sponsor. It's a good question. So rather than try to go through every scenario, most of the time, the DST is going to own between 1 and 3 properties, most of the time.
Okay.
And then those properties will sell at the same time. So if the DST buys an Amazon warehouse, they're selling the entire warehouse at some point down the road, right? Not just a portion of it. You do get DSTs that buy, that spread out the investment over multiple properties, more than just a handful. And there they still do try to sell the whole thing in one bucket. But so you tend to exit all at the same time. You tend to exit in 3 to 7 years in that window. And they tend to have other investments afterward that they want you to reinvest into right away. So they'll say, hey, here are the other opportunities that we're currently raising capital for. We want you to roll your money into this new DST. It's your choice, right? You're not forced to do that. You can do a 1031 into that DST, or into a different investment, or take a taxable sale, or some partial exchange where you exchange some and pull some cash out. That's all available to you. Most of the time, so I was talking with a DST sponsor yesterday, and they were raising capital for a new apartment complex in Dallas. They're going to sell that whole complex in the next handful of years, and then the investors will get to decide what they want to do afterward.
Gotcha.
Great questions. That's fabulous.
Yeah.
What else we can cover in here in the time that we've got? Nick, maybe I'll just turn this over to you, and you can talk about this slide. I'm sure you talk about this one a lot.
Yeah, absolutely. So, a lot of you on here have been active real estate investors, and that's what you've been used to, for the last several decades. And that's how you've amassed all the equity that you've amassed, right? So a little bit about Ironton Capital. So we're a general partner. You've heard Sean throw around the word sponsor, DST sponsor. So Ironton Capital invests directly with said sponsors, not DSTs, but we go to operators with strong track records. They've got a specialty. They really understand their market, and they've had a lot of success in that market. We allocate capital into those projects. So we have an investment committee. That's Lon, another guy, Richard, our CEO, Brent. They do all the due diligence on these sponsors, on those markets, and ultimately dictate how we're going to deploy our investors' capital with said sponsor. You, as the limited partner, all you have to do, such as if you're at a 1031, you're in a position where you're having to identify what you want to allocate your capital into. You're not held to any timeline with us, but you look at our funds that we have We have a medium-term, short-term income fund, and then a long-term fund, real estate equity offering. So here's a limited partner. You simply review the documents, go through the quarterly reports that we have, and then, with the income funds, we send you quarterly distributions, and you have the ability to either reinvest those every quarter or take the income, which many of you decide to do because you sold a rental property. You need to find something else to replace that cash flow. So you may not want to reinvest all your income on a quarterly basis. But essentially, we do all the work for you. We do all the vetting. We do the due diligence. When you're doing a 1031, you're doing all of that. Unless you're going into a DST, you're finding the right investments to go into. You're probably looking at like maybe 3 or 4 different markets. You're looking at probably 15 to 20 different properties if you can find them. So it is a ton of work, and that's what Lon does as part of the investment committee. But for you, it's completely passive. So if you're looking for more of a passive approach, we have many options for that. You will have to pay a little bit of capital gains tax, but for a lot of people, they more than make up for it by the higher returns that we're targeting in over a 5 to 10 year period in the funds.
Perfect.
And so diving in a little bit to the National Diversified Fund, you saw in the analysis, we use 17% as a projected rate of return. We're usually targeting between 16 and 20%. Now, there is no liquidity here. So 4 to 6 years, we have 2 one-year extensions if needed. So again, if you're going down the road of a 1031 and you ultimately don't decide to go down that path, obviously it's a fantastic solution for you if you want to defer your capital gains. And Sean, question for you. If a lot of investors, they probably own these properties for decades and they probably have fully depreciated that asset. If they do a 1031, do they get to defer the recapture tax paid on that depreciation as well?
They do, yeah. So there's
Okay.
4 types of taxes you can defer. Long-term capital gains is one, depreciation recapture is another, your state income tax or state capital gains tax, depending on where you're at, and then the net investment income tax, sometimes called the Medicare tax or the Obamacare tax, that also can get deferred.
Gotcha. Thank you for that. So if investing with us, we're going to be able to get you, have you defer some of those capital gains taxes. Of course, there's no liquidity, so you're with us for the 4 to 6 year time period. But we have a depreciation share class, which ultimately we can pass down to you guys, which allows you to offset a good chunk of that capital gains if you ultimately decide not to go the 1031 route. We structure our National Diversified Fund. Really, our thesis is the 4 pillars of diversification. So we want to spread your capital across multiple geographies, multiple asset classes, various strategies. A lot of what we do is ground up construction or value add multifamily. We have some other opportunities where we invest in asset classes such as industrial or warehouse, self-storage. We do some residential local projects here in Colorado as well. And then sponsor-wise, we like to spread your capital across at least 5 to 10 sponsors in any given fund. So our job is to protect your capital as much as possible while generating a strong return. And we really, there's not a lot of products out in the market that offer a diversification thesis like this through a private equity fund. So that's how we're structured. And then Katie's got a question here. Wanted to clarify, did you say the cash flow would be distributed quarterly? For our income funds, yes, they are distributed quarterly. Sean, for DSTs, do they do those distributions monthly or is that quarterly?
It's a mixture of both. You'll get some DSTs are called zero coupon, where they don't pay you a distribution at all. Some distribute quarterly, some distribute monthly.
Gotcha. Okay.
Whole range.
Mm-hmm.
This is a visual map.
Shows you to go through the whole NDF pack. Maybe we just kind of skip to a couple highlights at the end, and then we can.
Yeah, looks like we got about 15 minutes.
Do a Q&A. So
yeah,
I've got to believe that the 20 guys on the call here have got some other questions for Sean on just mechanics of 1031s and things like that. I want to make sure we have plenty of time for that.
Yeah, so I'll just leave this slide up here. We got a couple more, but this is pretty much it, guys. So we've got 15 minutes. Again, if you want to learn more about Ironton Capital's funds, whether your goal is cash flow or whether your goal is continuing to grow that capital and keep the snowball rolling down the hill, we've got a solution for that as well through our National Diversified Fund. So see if there's a link in the back here.
For the book?
Yeah.
There it is. Yep.
So if you guys want to do a free property analysis like the one Lon presented at the beginning, we can do that for you. We'll need some information, but you can go to irontoncapital.com/IC analysis, and then we'll run through that with you. And of course, if you want to do a free exchange consultation with Sean, you can go to 1031x.com/free consultation.
Mm-hmm. I want to say two things here quickly before we jump to other people's questions, and that is 1031s, you defer all of your taxes, as I mentioned, if you reinvest into new property that's worth at least as much as what you sold. So if you sell a $500,000 piece of property and you reinvest into a 500 or more, then if all the other rules, you can defer all your taxes. It's possible to trade into a property of lower value. So if you could sell at 500 and then reinvest at 350, that gap still represents potential taxable income to you, but it's possible to do that. It's called a partial exchange. And I'm bringing that up for two reasons. One, sometimes people want to deleverage as part of their exchange. And one way you do that is just by not putting debt on the new property, not as much debt on the new property, and you can pay tax on the difference. Or you can think you're going to do a fully deferred exchange, can't find anything you really like. Maybe you find something that's worth less, or maybe you don't find anything at all. And then you have a failed or a partial exchange. What do you do with the money that's left over from your 1031, right? If you started a 1031 and then it doesn't succeed or doesn't fully succeed, what are your options? Well, something you could do, and Lon, you and I have talked about this, you could say, I'm going to start the 1031 process just to see if I can find something that I really like and I can defer my taxes that way. You're basically buying a purchase option for the right to defer your taxes if the right investment comes along. But if you don't, you can always turn around after your exchange doesn't succeed and reinvest, say, into one of these funds or something else, right? Take your money and go put it in the stock market or something. You don't just have to take the money and eat the taxes and that's it. You get to do something with that leftover capital if the 1031 doesn't pan out the way you want. And there's no penalty for failing a 1031. The IRS, in fact, would never know. It's impossible to report the start of an exchange without the end result being a completed exchange. You only report successful exchanges. So one thing you could do if you're not sure is start down the 1031 road. And at the end of your 45-day identification period, if you don't think you're going to do a 1031 exchange, you couldn't find something, you can wipe out your ID list. And then on day 46, you can get your money back as if you never tried. You recognize the taxes at that point, but then you could roll into, say, one of these funds. It's an option that's available to you. And it's one way that you can sit on the fence until the right opportunity presents itself.
Really good strategy, because I've seen as a commercial broker, people get trapped in a 1031 mindset that I'd rather cut off my arm than send a nickel into the government. And they'll end up buying a really bad property or overpay for it. And it would have been so much better off if they just paid the taxes and waited for a better opportunity. So never feel like you're in a no choice situation, because that's never the case.
Yeah. And if somebody out there just wants to make sure they never send a nickel to Uncle Sam, they don't have to, I promise you have my utter complete sympathy, right? I mean, we get a lot of psychic satisfaction from stiff arming the IRS, but doesn't mean it's always the smartest decision for you. From an objective analysis standpoint, there are scenarios where the tax liability is not that high, or the reinvestment options are that poor based on what's best for your life circumstance. You'll want to think that through ahead of time and evaluate, what does it look like if I do an after-tax distribution into something else, including one of these funds.
Perfect.
Sean, you said something at the beginning that I thought really resonated with me personally, but you said to have that end goal in mind, right? When you're thinking about this 1031, because ultimately this isn't just a get rid of tax forever code. I mean, you got to keep, and the beginning of this presentation, the title slide says, get off the 1031 treadmill. Because, if you ultimately going down that 1031 path, the more you go down it, the more, you got to stay on it, or you're just going to be paying, all the taxes that were owed previously, all the depreciation recapture. So really I just want to reemphasize, really have that end goal in mind. You may be, as you keep going down that path, you might find yourself that you need to be on this 1031 train forever, just to, again, stiff arm the IRS. If that's not a path you want to go down, and you're going to be, if you're not going into DST, you're always going to be that active landlord. So I really think there's just so many different approaches you can have here. You could go down that path, which is great. It'll allow you to compound your net worth, indefinitely. But if you want to take that more passive approach, there are other options as well, such as with us at Ironton Capital. Again, we're always happy to run those analysis, but yeah, something I just wanted to re-emphasize there.
No doubt.
We got still a little stuck on the surprise aspect of DSTs. My takeaway feels like it's to get out of the DST as soon as possible after the initial 2-ish years and into the nationwide REITs, which is Real Estate Investment Trust, to avoid getting stuck with the DST selling sooner than expected. Is that a reasonably accurate takeaway, or is it somewhat unusual to get surprised?
Let me parse this out because there's several things going on in this question, Benson, that I want to make sure we understand clearly. The first is some DSTs are set up to convert into REITs automatically. Like that's the whole purpose of the DST, is to allow you to exchange into a REIT, which you cannot do directly. The way real estate investment trusts are structured, you're not buying real property. You're buying interest in a trust that's not considered like kind, so it doesn't work directly. So instead, what happens is you exchange into a DST, and then the DST converts into REIT shares at a certain future date. The process by which that happens is fascinating and way too complicated to go into right here. That's called an UPREIT, a Section 721 UPREIT is what we're talking about there. You can't just take any DST and convert that into REIT shares. Not all DSTs are structured that way, and most DST sponsors don't want that to happen. But some do, and you want to make sure you know that early on. So in terms of going into a REIT, only some DSTs are set up to do that. And most REITs are not structured to accept 1031 capital, whether through a DST or otherwise. So be very careful about, what you're planning to do and who you're working with, and make sure that's an option that's available to you. And sometimes the conversion from DST to REIT is not optional. Sometimes it is, but sometimes it's not. If you're in the investment, it's going to convert, and you're going to get REIT shares. And this is why that matters. REIT shares, when you sell them, it's not real property. You cannot do a 1031 exchange after you liquidate some REIT shares, right? You are stuck paying the tax no matter what once it converts into a REIT. The second thing I want to highlight here, maybe the third at this point, is the surprise element of a DST. DSTs are very tightly regulated, and there's a ton that the sponsor cannot do once they're stuck in the investment, right? They can't refinance, they can't bring in new investors after a certain period, right? There's a whole list of rules that the sponsor has to abide by. So the element of surprise you get from a DST sponsor could be in the range of, we're selling sooner than we thought or later than we thought. The property is not performing the way we wanted it to, or it is, or maybe the sponsor has, their operating board has decided, we're going to convert the DST into a different structure. Sometimes that's allowed and sometimes it's not. And at that point, you'll usually get a notification on what your tax options there. Most of the time, you do not have the flexibility to say, okay, it's been 2 years and now here's what I want to do with my investment with the DST. You are stuck. You've gotten in the car. Someone else is driving. You're waiting until you get to a destination they take you to.
Yeah, because ultimately the assets have to sell, right? And if you're at a period where it's a terrible time to sell that asset, maybe interest rates are really high and it's just not an advantageous scenario, then, they're not, you're stuck in it. You ultimately have to sell it to get any capital back, just like any real estate investment.
It's worked out great.
Yeah. It's a great way to spend an evening, right? With smart people talking about interesting topics. There's a whole universe of human beings out there that would find all of this way too dry and not at all interesting. But when you get the right crowd together, this is a real joy.
Yeah, it's funny, when I was telling my wife I was going to write this book with you, she said, God, that sounds really boring. I said, it's really boring until you're looking at sending a check for 150 grand to the government, and then suddenly it becomes very fascinating. So it's very interesting to a very small number of people, but they're people I want to get to know.
Yeah, no doubt. I think your wife and mine have similar sensibilities there.
Yeah, you go and get cocktails while we're writing, I guess.
That's right.
Well, feel free to reach out to us anytime if you think of questions. We're really glad that you guys took the time to be with us this evening.